Welcome to Zen and the Art of Real Estate Investing, one of the fastest growing real estate investing podcasts in the world. What if you could learn from experienced real estate investors? Find out what got them to where they are now. Get insight into their daily habits and take these insights to inspire your own growth. Each episode, Jonathan Greene shares an in-depth look at the mindful approach to real estate investing. Jonathan is a lifelong real estate investor and the founder of Streamline, a data-driven, investor-friendly, independent real estate brokerage located in Madison, New Jersey. Whether you're looking to start from scratch, get to the next level, or just for a straightforward and honest approach to real estate investing, this is the free mentorship program you can take with you anywhere. Now, here's Jonathan.
Welcome back to another episode of Zen and the Art of Real Estate Investing. My guest today is John McNellis, 40 years in the game developing shopping centers, mixed-use projects, and office buildings across Northern California. He co-founded McNellis Partners in the mid-'80s, and he's been doing it ever since. Let's get to the knowledge. Episode 353, John McNellis. This is episode 353 of Zen and the Art of Real Estate Investing with my guest, John McNellis. John is a developer, investor, writer, lecturer, and a principal at McNellis Partners. He's also the author of Making It in Real Estate, Thriving as a Developer. John, welcome to the show.
Thank you, Jonathan. A pleasure to be with you today.
Yeah, it's good to talk to you. We've got the two formations of John and two former lawyers, still lawyers, right? We still count ourselves as lawyers, right? Do you?
Yeah. I was called as a witness once in a trial, and they asked me if I was a lawyer, and I said, well, it's kind of like I was a Catholic, when I was a kid. You can't shake it.
Yeah, I always used to joke with people, and this will go to the real estate end too. When I was a practicing attorney and I was a trial attorney, criminal for a long time, when people asked me what I did, I would kind of say, oh, I'm an attorney, because they would always go, ugh. And then now, like when you say you're in real estate, and like I know your mom was a broker, I have my own brokerage as well. You say you're in real estate, they still say ugh. I don't know why. we can't escape it. Did you think you were going to go in to be a lawyer, or were you always interested in real estate?
No, actually, back to the writing part of it, Jonathan.
Yeah.
When I was a kid, if you and I were spoken to Joanne when we were 20 years old, and you asked me, what do you want to be? I would have said a famous writer. And I was a journalism major in college.
Wow.
And then I woke up my senior year and said, whoa, dude, I don't want to be a journalist. I don't want to report what other people do. But I had no talent. And I wasn't any good at science, math. I was just okay with basic arithmetic.
Yeah.
And so I said, I better go to law school. And then, of course, I wanted to be like Perry Mason and do trials and whatnot. And got a job with a fancy law firm in San Francisco out of law school. And within a month or two of being in the litigation department, said, I hate this. It's absolute. You're basically, if you're part of this, you're trained to become like a professional fighter or a professional asshole, I guess I would say.
I lived that.
The firm had a real estate department, and I managed to, over the course of a year or so, sweet talk the managing partner into letting me become a real estate lawyer.
Yeah.
But so that I kind of fell into it.
Yeah, it's interesting. So when I was in law school, my favorite class was real property. And it was because I grew up with a dad who was an investor, but I was really connected to it. But then I didn't go private. So I worked for the government. So I was still working 100-hour weeks just for a lot less pay. So it was worse for me, but I enjoyed that part. But I feel like my legal background has helped me so much in real estate over the years. My dad was a lawyer, and it always helped him as an investor. Do you think it served you well going into all parts of real estate that you had over the years?
I did, but kind of in an odd way. First, so when I was a young lawyer, when I shifted over to the development side, we were representing the money in deals. And so I would see the developers come and go. And so I got used to, at least in my head, dealing with large numbers. And then meanwhile, I was doing little deals on the side, nights and weekends. We were buying houses and fixing them up, with maybe 100th the cost. So, I got very comfortable with large deals. B, I met a lot of the right people, and I've also got a good basic understanding of contracts and joint venture agreements in financing. And that all helped. And then also when I started out on my own with my partners, I'll make up a number, Jonathan. Maybe we saved $50,000 a year in legal expenses because maybe for the first 10 years or so when we were starting out, I acted as the partnership's lawyer. Until one day, a fellow from Safeway, a big market chain here on the West Coast, said, "John, you should stop representing yourself." And I thought, that's probably good advice.
Yeah, I represented myself to try to evict a client and a tenant in New York just one time because my sister was like, "Can you just go do it?" I went and did it, and then I realized like I never want to do this again because New York's obviously extremely tenant friendly and was a very short hearing, even though they were 6 months late on paying rent.
But did you get them out?
No. The judge looked at me directly in the face and said they're trying. They eventually did catch up. I like them. I didn't want to evict them, but it's just a part of real estate where you like actually have to show that something's going to happen. Did you find that it was really interesting to have that looking at the large scale of what everybody else was doing, but then starting the way a lot of real estate investors do on just regular single family homes, house flips? How was that? Because you're seeing both ends of the spectrum and I guess both are hard in their own way.
I think what it did, it's actually just occurring to me now for the first time. I think the law practice and doing the larger deals for clients enabled me to skip a bunch of steps, to go from, let's call it rookie ball, buying houses, duplexes, fixing them up, to jumping up to much larger deals without doing AA, AAA ball.
Yeah.
In hindsight, because I met the guys with money, I knew the banks, and it worked out. Yeah, actually, I should be kinder to the legal profession than I usually am, but that did work out.
Yeah, because the partnership aspect and how to get money and who has the money and how it gets delivered in terms of large deals, that makes sense to me because if you know that, there's a small amount of people playing in that arena, whereas there's a million people playing in the flipping one house here from, the time that we have all been doing it.
But still, when people come to me, young guys come to me and say, "Hey, John, how do I get into it?" I tell everybody the same thing. Find the best house in the worst house in the best neighborhood.
Yeah.
You can't buy it and fix it up because they're perfect training wheels deals. They have all the components, the negotiating, the brokerage, the escrow, title, and everything that a large deal has. They're just simpler.
Yeah, how do you convince someone new that it's okay to take action? I feel like now everyone's so obsessed with technology. You and I obviously were doing real estate before there was all these fancy spreadsheets. It was more smell test stuff for me, even though I ran numbers. But I feel like now people they put it into AI or they put it in there, oh, that deal doesn't work. Whereas they don't understand you have to get the feel for it by going to the houses, seeing it, understanding how the money works, and kind of, you have to get that first experience somehow or else they're going to keep saying no.
Yeah, no, I agree. And we don't use any of those fancy analytics.
Me neither.
Spoiler alert. It's essentially a back of a napkin. Someone pitches me a deal. I said, if you can't tell me the deal, in the elevator, and not that many stops, it's, John, we're going to buy this 20-unit apartment building for $180,000 a door. I'm making up numbers.
Yeah.
We're going to put $20,000 a door into it. Usual paint, carpet, new countertops, paint the outside, and all the comps sell for $300 a door. That's about 3 floors worth of pitch. In the elevator. I said, okay, I can see that.
Got the gist. Yeah.
I got the gist. But don't give me Argus runs and IRRs and all kinds of spreadsheets that I don't need.
I agree. And I think the funniest thing that I've say to people is now all of those things are just projections anyway. It's not real. Like, you haven't done the deal yet. I don't know if you're even competent to complete the things that you say are going to get you the 20% IRR. So I'm banking on a fallacy in the first place.
Okay, if I can jump in there.
Yeah.
I think I devote a chapter to that in the book. I think the IRR is absolute, utter crap.
Yeah.
For those of you who aren't experienced with it, what the IRR Instead of buying a building today that with a 6% return, if someone will say, "Oh, the IRR is 12," which sounds much better than 12% than 6. But the way they do that is they say, 10 years from now, we're going to sell this building at a 4 cap, or we're going to sell it for $10 million. And that is exactly like predicting how much it's going to rain 10
Yeah.
years from now.
Yeah.
The numbers won't lie, but the assumptions are absolute bunk.
Right.
So all we look at, guys, when we buy a property is what's it return today, and once we fix it up, say a year from now, what's the stabilized income going to be? What's the return on investment? That's all we look at.
Yeah, I mean, I still tell new people every part of real estate you can still do the way that all of us did it in the old days when the MLS wasn't on the internet, where there was no pictures. You had to drive for dollars. You pulled over when you saw a dump because, hey, that could be a deal, and knock on the door. You could still do that. I mean, people are spending enormous amount of monies on, marketing and Facebook ads when they could just drive around their block, look for whatever they want, single family homes, commercial assets, which I think are actually more findable driving for dollars than people think.
Yeah, I think you're right.
Because if you're in your head and you're a new person, everyone's thinking initially like, oh, I'll just try to find houses. But all the opportunity, at least when you're just driving in random areas, it's usually in commercial to me. It's in a lot of different things, even industrial. I think people don't really open their mind to it because maybe they're a little scared. They don't have the experience. But if you're just driving around, there's a lot of deals you can find. You just have to kind of open your mind to it.
Yeah, I would caution against trying to buy as your first deal or 2 or 3 deals a commercial, because it is a lot more complicated.
It is, yeah.
And the thing I love about residential, at least here in California, and I'm guessing it's true in New Jersey, is that you can pretty much count on a 0 vacancy factor.
Yeah.
You may not get the rent that you want, or you may not get the sales price you want, but you can move it, you can rent it. Whereas commercial, my world is neighborhood shopping centers.
Yeah.
I've had spaces within centers never lease. They're in the corner, they're facing the wrong side.
Right.
And of course, the office market is in shambles right now. You've got hundreds of millions of feet sitting there that will probably never lease.
Yeah.
So I'll tell you, my son-in-law, he came up with a clever idea, because he and my daughter are buying and flipping houses. He did something that really impressed me, and I wish I had thought of it to tell him. He went to Costco and bought like a case of cheap but expensive looking wine, with a fancy label on it. And then in the neighborhood that he wanted to buy, he went kind of door to door, looking at all the houses that looked like they were abandoned or in shambles or run down.
Yeah.
And he left a bottle of wine with a note that says, which was true, that my wife and I are renting in the neighborhood. We'd like to buy a place. We're trying to buy a home here, so we can live here. And lo and behold, it worked. And he got a call. I guess the lady liked the wine, but I was shocked, but it worked. And I thought, that's a clever idea for somebody starting out.
Yeah, I think it's great. And I think it could still work. But I also agree with what you said about commercial. I do think it's scary, or rightfully so, for someone new, especially for buying into a commercial asset. Like I owned a 5-plex strip mall that my dad left me, and it looked easy growing up. But then as an adult, after my dad passed away and my sister and I were managing, once we got our first vacancy, it wasn't as easy as I thought, to just say like, oh, that's going to be fine. Everybody wants to be, the corner part of a little 5-plex in a town that has almost nothing, So that was a really good point. And I think shopping centers, that's a good point about it. There's locations inside of commercial that may not be attractive if you're talking about a lot of businesses.
Right. And actually, it gets quite complicated. Just as an overview, if you're going to get into retail and neighborhood community centers, malls, whatever, strip centers, I think you kind of have to go all in. It's a specialty. It's just like hotels. We don't do hotels. That's running a business. Retail, Jonathan, I can look at, here's one of the basic tenet of retail. If it's a market, you want to be on the going home side of the street, because people do their shopping on their way home.
Yeah.
If it's fast food, particularly if it's coffee, you want to be on the going to work side of the street. I mean, I can look at an intersection and say, okay, that's going to be a good center, and across the street isn't. That's just what traffic flows. And it's kind of I wouldn't call it a fraternity, but in retail, you end up dealing, one of the good parts about it is you deal with the same people year in, year out. And so I deal with Starbucks repeatedly, Walmart repeatedly, Ross, all these national tenants. So the good news is you become friends, or at least friendly acquaintances. But there's all this inside baseball or inside knowledge going on that if you just kind of come in and in your case, you inherit a small center, or you buy a small center, you don't know what's really going on.
Yeah.
It's kind of hard to crack into.
Yeah, that's it. And I think that once you develop those relationships, then you kind of know exactly what their buy box is per market. So you can basically source something knowing that, say it's a smaller, or if you want them as an anchor, you want Starbucks as an anchor, and hey, they're going to anchor this property after you've done a few deals with them. Does that help you when you're looking at a shopping center? You have relationships with these retailers, and you're like, I know these three are good to go. So you can kind of build off that as you go.
Yeah, excellent point. Yeah, you can say, wow, Jonathan's little center that he can't lease for some reason. If I buy it, here are the guys that he hasn't thought of that I could probably put in there.
Right.
And while I'm in escrow with you to buy it, I can call because I've got the firsthand information. So I can say, hey, do you like the corner of First and Main? And they say, no, hate it. Then, whoops, sorry, we're dropping the escrow. Or, wow, yeah, we always wanted to get in there and we couldn't get through to the owner. Great, we'll jump on it. What we don't, with being an insider, you don't get, I get the same answer that you would, but I get that answer really quick. I can make a phone call immediately and they'll say, nah, we're not interested. If you as an outsider or a beginner, you don't know who to call, you write them a letter and they don't know who you are, and you might not find out for a few months.
Yeah, that was me. I thought this would be perfect for Verizon. How the hell do I get in touch with someone at Verizon? It just wasn't smart. I'm curious because I just was thinking about this as you were talking. Almost all, if not all, major shopping center purchases, they're purchased from somebody else who's running a shopping center, right? It's not because you're either doing a ground up development or you're buying in. So how do you look at the mix of tenants that they have and decide where you can do an operational upgrade? Like, are you usually moving tenants out, like you said, or are you just looking at their operations saying, actually, they have pretty good tenants, they're just terrible operators, which I'm sure both happen at some point?
It depends. Sometimes earlier in our career, we would buy centers that were, say, 70, 80% vacant. So this is a teardown. The anchor has left. The remaining tenants are few and far between. But we'd say, like, for example, we bought one in a suburb of Sacramento called Rancho Cordova, 20 acres, a couple 100,000 feet of tenants. And there were maybe two good tenants out of the whole bunch.
Oh, wow.
One was Bank of America, but we knew, because we've been working with Walmart for years and we've been working with Safeway for years, we knew that if we could buy the center and we had to buy out some of the remaining tenants.
Yeah.
We knew we could tear it down and we'd build a brand new center with just 3 or 4 tenants. So there's that. That's when the center is terminally ill. Or we'll look at one where it's 80% leased and it can't get above 80%, which is, I'm sure that's you're losing money if you're only 80% leased.
Yeah.
It's like, why can't we get it? One of the biggest lies in the business that you hear from like every broker, it's, oh man, it's a great property. It's just that the owner is no good at managing. And it's like, really? Chances are they're pretty good at managing it. It's just a way to get you to buy it. So you have to figure out why. Is there some structural problem with it? Not enough parking, not enough visibility. And then, sometimes properties, ultimately, we're all going to die. The properties end up in the wrong hands. So the father or the grandfather was a brilliant developer or owner. Yeah. But now it's owned by 20 offspring and there's a bank trust that's managing it and we're doing a terrible job, which is another good tip. That's your perfect seller.
Yeah, right.
Bank department.
Yeah, I mean, I just had an episode the other day where we were discussing passing down real estate. Oh, actually, I was on a show where we were talking about it. And for me, it's how I grew up. And like I was always involved in real estate from time I was a baby. But I feel like a lot of kids now would get something. Maybe it's just one kid, not in this giant trust that they don't know how to manage. But I don't think they want to take over a shopping center. I would be charged up. I wouldn't know how to operate it, but I would be excited. But I think a lot of people look at it and think it's a lot of work, a lot of moving pieces. It's not easy, but boy, what an asset if a parent handed you a shopping center and you just
Sure.
like give it up because you can't manage it. That would be crazy to me.
Right. But it takes, like any job worth having, it takes 5 years maybe to get pretty good at running properties,
Yeah.
and longer than that for developing. So if someone hands you a shopping center, you're going to pay a lot of
You're in
tuition.
trouble. Right. You're going to pay a dummy tax for a while.
Yeah.
Yeah. You mentioned briefly, what are the things that hold the shopping center back? Those ones that they're trying to convince you, oh, look, I'm a bad operator. You said parking, and I know directional location for where it is, but are there other things about a shopping center? Like, could they have built it wrong? Where they've I don't know, they've just left these kind of corner spaces that no one would ever want.
Well, lots of there's more than one road to ruin. Often, the anchor has gone away. Think about it.
Yeah.
There are Sears, J.C. Penney, just one tenant after another that has come and gone. So maybe it was a great center when it was first built, and it was built around J.C. Penney or Kmart. Or Rite Aid just went bankrupt on us. So if you lose your anchor tenant, then immediately what happens is all the shop tenants begin to suffer because there's no longer the draw. And so they come to you and say, gee, we're sorry, we're shutting down, or we need to pay 50% rent. So losing the anchor. The other thing that can happen to you in a town where it's relatively easy to develop is someone can, a quarter mile down the road at a better location, can build a newer, snazzier center.
Yeah.
Here, we have Safeway, we have Whole Foods, Vaughn's, Kroger's. So the next supermarket comes in. Your supermarket's 30,000 feet because it's an older model,
right,
and now
right.
the battleship size is 60,000 feet. And whoops, your center is out in the cold. So it can be the tenants. It can be that, let's say, not to pick on doctors, but they're notoriously bad at business. A group of doctors built the property not knowing what they were doing, and that they put it in the wrong location. There isn't enough, and this is one that you and I would pass on. Well, guys, there isn't enough traffic on this street, to validate having a shopping center there. So that's when you say, we can't. You can do anything, as you know, but other than move the land, and so sometimes it's just a bad location. We need to tear it down, and what's popular now is to replace it with housing.
Yeah, I mean, I can see. I mean, definitely have affordable housing issues, but it's still, you have to do a full knockdown. It's not that easy to just kind of transition a J.C. Penney into an apartment building because they're not built the same way.
That's right. Yeah.
Yeah. Yeah, it's interesting to think, though. I think from what you're saying is that traffic patterns are still as important as they always were. Part of me thinks, well, I mean, everyone can find stuff on Google Maps, but it's not the same because Google Maps you go into when you know you're going to go somewhere. The cool plaza is like, oh, look, I didn't know there. I did that the other day. I was like, I didn't realize there was all these other things in a certain plaza. And now I'm more likely to stop there because I went there for a reason and saw the other good stuff.
Yeah, I don't think there's a single American that likes doing left turns into properties. Happiness is a right in, right out. Yeah. You want to be able to whip in, whip out, which is why the supermarket wants to be on that going home side. So there's no crossing traffic, and why Starbucks wants to be on the going to work side. A lot of it, I've had this conversation. I think I stopped 20, 30 years ago. I used to say, gee, Walmart, you guys can go anywhere. They'll find you. And they say, that's true, but we're not taking any chances. We need to go in the best location possible. We're not going to take a risk. So
Yeah.
it has to be the A intersection with lots of visibility, lots of parking.
Yeah, it's a great point that I didn't think of, but now that you brought it up, there in New Jersey they have a lot of the roads with you can't make a left turn, so you have to do the loop-de-loop. A lot of times I'm not going to do it. I just don't want to. It's annoying. I don't know why. It's just like one of those things. You're right. I think you have a new book though. Happiness is an easy right turn. I mean it really is. It makes sense for shopping center.
It'd be a tattoo.
Yeah.
Happiness is right in, right out.
Yeah. I mean, it really does make sense because I think that if someone's going, they're only going to start, like, you're just not going to do the extra effort unless you're going there on purpose. It makes a lot of sense.
Okay. So we settled that point.
Yeah, that's it. Yeah. Hey, it's Jonathan. I hope you're enjoying this episode with John McNellis, a double John episode with two former attorneys. But on this brief interlude, I wanted to remind you that if you have a growing real estate portfolio or you're buying investment properties, especially this year, and you're wanting to get that benefit for next year, you might want to entertain a cost segregation. If you're interested in doing a cost seg on one of your properties or more, go to mavencostseg.com/Greene. That's my link to my guy, Sean Graham at Maven Cost Seg. Let's get back to the show. What other asset classes have you enjoyed over your career?
Well, enjoyed is somewhat freighted, but
there's done well, enjoyed. They can not always go together.
So still like most people that started with nothing. I started in residential with the classic house. That actually I bought a duplex for when I was 24 years old for about $25,000. Put down $1,500. I scraped it together. It was in a crappy town, which was my hometown. Yeah. But it was a rising market. Jonathan, we sold it a year later for almost $60,000. But did a trade, and with that trade, I bought a fourplex for $60,000. The market was still rising, and then I traded that a year later at $120,000. So $1,500 became like $90,000 in equity.
Yeah.
And for the last 50 years, I've never done anything close to that.
That's a dream scenario.
But that kind of return, but that sort of launched me. And then meanwhile, I was practicing law and getting a little bit more complicated. And then I figured, learn how to do partnerships. And so started in residential, moved from residential to industrial. And then we learned the hard way. If we bought an industrial building, and I think I was still in my 20s. We bought a 40,000-foot industrial building in Sacramento. And we learned very much the hard way that if there is a guy in town that has his own construction company and owns an ocean of dirt, there is no way that you're going to make a dime in industrial, because every time rents would go up 1 penny, the guy would build another 500,000 square feet of industrial space. And then, of course, he'd sell it. So I think we came out okay. We got our money back when we sold that, but not much more. Yeah. So then at that point, passed on residential, and I fell into retail with a former client. And then since then, as retail has evolved, we've had to do mixed use. The cities, and I'm sure it's pandemic across the country. Yeah. But California, if the town is crying for 500 apartment units, that's the need. Then the town says, okay, but it has to be mixed use, and you need to throw in retail on the ground floor. And back to that old bugaboo traffic, I can show from, guys, there must be 1,000 bad mixed use projects between where I'm sitting in Northern California, Palo Alto, and Southern California, because the cities say, put them in. The residential guys, they view it as a loss leader. They kind of, raise their eyebrows, nod, say, okay, we'll put in this mixed use, and then there's not enough traffic.
Yeah.
But so we're involved in a couple of those, and they've been difficult, frankly. But
it's a hard dynamic because the residential profile isn't the same as the retail profile. I think a lot of people think, oh, well, at least you get everyone in the building to shop there, but that's not sustainable. The who drives by to go to a Walmart isn't also looking to want to live there. You don't want to live at the Walmart.
That's right. And back to the whole convenience, right in, right out thing. A lot of these mixed use projects, they're gorgeous. They're 10 stories and they look really fancy, but the parking is in underground, or it's in the building. And you know how a deer will not jump over a fence if it doesn't know what's on the other side, right?
Yeah.
We don't, our species, we don't really like driving into dark garages if we can avoid it. And we'd much rather pull up and park in front, and that's a fight we have with city planners. They say, oh yeah, we want the building to look much nicer if it fronts on the street. Then I say, well, but the customers can't see the parking. They don't know where it is. So that's a struggle.
And then I lived that struggle. I owned a place in California, actually, in Encinitas on top of Pacific Station. At the time, there was a Whole Foods on the bottom, and maybe I think there was a bar and a couple other places. And it wasn't a big complex. There's maybe, I think, 14 units. And we have one of the units on top, but the parking was underground. I could literally never find it. I didn't go there that much. And then that was one of the only Whole Foods that I ever saw go out of business. It was really interesting, based on what you're saying, to watch what happened. And I didn't ask my sister what went in there to replace the Whole Foods, but I remember when I first asked, it was something that I didn't think was going to last.
Yeah.
And it's on a steady thoroughfare on the main road of Encinitas, but there's just something, like you're saying, it's hard to do mixed use the right way. It just might not make sense for a lot of people.
Yeah, and it makes a ton of sense in New York City, in London. What you really need for mixed use, if it's back to traffic, but instead of vehicular traffic, it's pedestrian traffic.
Yeah.
If you've got a ton of people walking by, Grand Central Station, classic example. If you've got, then it's great. That shopping works great, but you can't take the highly concentrated urban approach and then plop it out into the suburbs. People saying, no, this is why I live in the suburbs. I've got my car, I can park for free. I don't have to do that stuff.
And I guess from a developer's point of view, it's hard to think, hey, I'm going to use whatever 50,000 square feet for parking that could be residential apartments, to do outdoor parking instead of underground. But you're very, very right. I do not like parking underground. I don't like parking garages at all. I hate them. I hate winding up and down them. It's very annoying. So I can see where these things play a factor. It's pretty interesting. I didn't think of it before, but I remember always going to that place at Pacific Station and being annoyed that I didn't know where it was, and I didn't think there was enough parking.
Yeah, you and everybody else. No one likes parking garages. Okay,
yeah.
So that's the problem with mixed use.
Yeah,
what world problem can we solve?
Yeah, right. I mean, do you think I was reading something in the pre-stuff that you sent me? You think retail is unstoppable, but it's changing. Why is it always going to continue to be a viable asset with Amazon and everything developing the way that it has?
Yeah. So one of the things I do, Jonathan, I write for the San Francisco Business Times, a monthly real estate column, and also for the Registry magazine, which is a commercial real estate magazine. And so I've been doing this for about 20 years. And it was around 20 years ago, 2006, when the Wall Street Journal and everybody else said, in bold, like World War III letters, retail is dead.
Yeah.
In fact, even before that, in 1998, when Webvan, which was all home delivery, came out, retail is dead, and the institutions bought that. So the institutional investors, the big guys out of Manhattan, they put let's say 5 or 7 top real estate disciplines: office, hotel, residential, multifamily, so on. They put retail last. And so, our prices were lower, our cap rates were higher, and we didn't really care. But then we came sailing through COVID. That we had a rough 3 or 4 months when our governor shut us down for too long. But our shopping centers just did super. And so now, we're kind of back to we're at the top of the investment choices. So the Wall Street guys said, yeah, we want more retail centers. they've been pronouncing the death of retail for a while. What's happened is that the two big players in my world are Walmart on one side and Amazon on the other. So Amazon came out from the internet, Walmart from bricks and mortar, and now they're both totally conversant. Walmart is brilliant online. Amazon, as you know, owns Whole Foods.
Yeah.
So they have married successfully. It's like the Northern Pacific and Central railroads meeting, wherever they met in the 1800s. I think it was Nebraska or somewhere. So what's happened, all the retailers that are still vibrant, they now are totally conversant with online.
Yeah.
What's happened is that has tended to, we call them the floor plates. It's tended to shrink. So before, let's say Macy's, everybody knows Macy's. If I went into Macy's and said, I want this jersey that I'm wearing, they'd say, great, how many you want? 10. And they'd have them. Now you go in and they go 1 and they tell you, okay, you'll have the other 9 tomorrow. We will send them over from the warehouse.
Yeah.
So they need less floor space. So the big footprints of the bigger retailers have been shrinking, which causes a problem in our world. But my particular niche, which is the neighborhood shopping center, so supermarket, drugstore, bank, pizza, nails, those are running almost full here in Northern California because we still everybody wants to get out of the house.
Yeah.
And in fact, I was just had coffee yesterday with the head of nationwide head of Albertsons, who said that their online sales are they're up to about 15% versus 85% in person, and then that's kind of stabilized. Most people, it goes back to, do you want some minimum wage guy to pick your tomatoes for you?
Yeah.
And most people don't. Here in the Bay Area, a lot of the techies, they work 18 hours a day and they never see daylight. I don't think they care.
Yeah.
But most of us would rather, squeeze the fruit and look at the meat. I think retail isn't in any danger at all.
Yeah, me neither. I wanted to get your take on this because I just read an article a couple of days ago, and it goes to what you were saying about not having stock in there. Amazon opened their first Audible storefront for audiobooks with obviously no books. You go in, it's in the city in New York City. You go in and they have listening booths and cool places that you can, just basically listen. I thought that's a really interesting use of space because I'm someone who I read a ton, but I also listen on Audible a ton. I would go there. And that's an interesting reuse of space where you're not, I guess, trading goods like that, but they could be ordering Audible right there into their account that they already have, which goes right through Amazon. As you were saying, they're very obviously good at that. What do you think about that as a business proposition?
That's the first time I've heard of it. It makes sense to me. In the old days, you used to be able to go into a record store and listen to records before you bought them, and that seemed to work just fine.
Yeah.
So I like the idea. People want to get out of the house. People want, we're herd creatures. We want to be together. So I'm bullish on retail. I'll go on the record on that.
Yeah, especially given what you said. I think about it a lot. I'm a very regimented person, so I mostly have a schedule. I know exactly where I'm going. But when I'm in places that aren't on my schedule and I'm driving by and I'm thirsty, like I'm looking at that neighborhood complex every single time. Like, oh, is there a Just Salad in here? I want to go there. And then there's other stuff there. And then it might become a preferred shopping center, like you said, because of the way I go and the way the traffic goes that way. And the other side doesn't get a lot of looks.
Right. Because right in, right out.
Yeah. I'm thinking of it though, just because what you said, there's a place nearby me where I used to always go to where there's a Chopped and a Trader Joe's, always packed, ransacked, the whole lot. You can never find a space. Across the street, they have another thing. I don't even know what's in there. I know it's not very good. There's no one ever there. So it's just they just made a big mistake by thinking, oh, we can compete across the street, but you really can't because they must know that the way the traffic goes, the majority is going past Trader Joe's.
Yeah, that's right. Well, Trader Joe's is a phenomenon. We have several in our portfolio, and they're just Yeah, wonderful stores, uh, brilliant, brilliant merchants. And a truly brilliant merchant, Trader Joe's, you could probably hide it in some cul-de-sacs,
Yeah,
and
you're
people
right.
would still go find it. But
But
again, when you try to talk Trader Joe's into that, they'll say, "No way, we need to be at the A+ location." But
but
uh,
they, based on a lot of what you said, they're also an interesting model because they don't need the same amount of square footage. They're not like a giant supermarket. They have limited aisles, limited stuff, but all good. If you're a Trader Joe's person, you go and you like everything. You can't get out of there without 18 snacks. It's just impossible.
right, yeah, they're about 12, 13,000 feet versus the full battleship size market these days here on the West Coast is about 60,000 feet. And
Yeah.
then there are various gradations in between, but and Trader Joe's does an enormous volume per square foot. If you can get one of those as your anchor tenant, you're in good shape, ladies and gentlemen.
Yeah. And that's really the big thing. If you have an anchor tenant for a redo or a new place, you already know you're going to be okay because having the Trader Joe's there is going to attract other people who want to be near that Trader Joe's traffic.
That's right.
Yeah.
But retail gets just to stick with it, get a little more inside baseball. If you don't know what you're doing and you see a shopping center and say, "Wow, this is a good center. I want to buy it," and then what we don't know is that the supermarket can be doing too poorly and then planning to close, which is more obvious,
Yeah.
or it can be doing so well. Let's say they're in 30 or 40,000 feet, a model from 15 or 20 years ago, but you don't know that they could be with one of their preferred developers looking at
Go for
another
more.
site in town to build a new store. And the moment they move out, the value of your investment just dropped by 50%. So
Yeah.
again, it's just a reason why if you're going to get into retail, do it 100%.
Yeah. I wanted to get your take on this because so a lot of people in residential, even in residential development, and also just for regular home buyers, one of the smartest things you can do is track where these smart companies are going in. Maybe they're in a small place. Like if there's a new Starbucks coming, that's a pretty good bet that real estate market on the residential end is good. Are you in line with that? Does that kind of jive with what you've seen across your career? For the smaller versions, I mean, the Starbucks going into an area where there wasn't one, pretty good sign they have the money to do all of that demographic research.
Yes. That's definitely true for staying within retail. If you see, let's say you plot me down in any town in America, and I just drive around for a little while,
Yeah,
just by looking at who is where, if where the quality tenants are, they've already done their research. They're at the
exactly.
best
Yeah.
institution. When Walgreens was on a roll nationwide years ago, Walgreens was vastly overpaying, but they were invariably at the very best location that they could get because they were paying the top rents. So I would just look and say, okay, Walgreens is at this corner. This is a great corner. Now, how that translates up to the residential, that's not our expertise, but you know. But if you see a Starbucks, that does tell you that there's a certain amount of affluence in the neighborhood, right?
Yeah.
A pool supply store. Uh, Again, if you're thinking about buying a shopping center, better to buy one where there's some, pools, pool, what's it called, pools, etc., or one of the pool guys. That is a good tenant because that tells you there's a lot of kind of wealthier homes in the
Yeah.
neighborhood.
Yeah.
Whereas if you see a dojo or a karate studio or a cigarette store, that's telling you, yeah, no, that's a third tier market or shopping center that you don't want to buy that.
Yeah, and a lot of people have switched from following the Starbucks Trader Joe's to now Benjamin Moore and obviously Home Depot and Lowe's, but like more of the paint companies because now you're like, okay, these people are going to want to do a lot of redos, not in the way because like if you're in a maybe like a C class area, they're probably not going to Benjamin Moore. They're going to go to Lowe's and get Behr or something. But the Benjamin Moore regular startup or a Sherwin-Williams or something, that seems to be a new sign that people are using. And that's not a big shop retail like you guys do, but it's an interesting note to see what retail can do for residential housing in the area.
It's usually the housing comes first, then the retail.
Yeah,
Uh,
so they know they have a good.
right.
Yeah.
Yep. So if you're pitching a market on a particular neighborhood, they'll say, how many rooftops are there? Or they'll say, we'll need another 1,000 rooftops, within whatever the radius, mile radius, 2 mile radius,
Yeah.
whatever they use. And they say, that area is just a little too green for us. Get back to us when you have another 5,000 rooftops if it's a bigger deal.
Yeah. Geographically, have you stayed like around California, Northern California your whole career, or have you branched out in terms of the larger commercial assets?
And no, if all within essentially a 2 hour drive from where I'm sitting.
Wow.
We're kind of lazy. And, uh, what we do is difficult. Fighting with cities, fighting with contractors, tenants, trying to get things done. So, Jonathan, I like to be able to head out first thing in the morning, get out to a project, within an hour to two, have the meeting with the mayor, have the meeting with the tenant or the property managers, and then get back to the office. And one way, we're a smaller firm, and there are much, much larger players in our world that we have to compete against, and but they're nationwide.
Right.
So in our backyard in the Greater Bay Area, let's say a 2 hour drive from San Francisco, we can be as competitive as anyone. You can call me and say, "Oh, what do you think about this location in Hayward?" And I say, "Okay, yeah, I know that intersection. We can jump right on it." So, and there are enough opportunities here. I mean, it's hard. Of course, it's always hard. So, we've stayed very close to home. Now, we have bought finished properties in Southern California and Oregon, actually a Trader Joe's center, but they were finished. It was easy. There wasn't anything to do other than buy it at a price and hopefully reap the benefits.
Yeah, but by staying in that 2 hour radius, you've built all the relationships. It makes everything a lot smoother than somebody like you just decide, say you had to go into Oregon and now you have to, do a whole redevelopment. You don't want to do that. I mean, to me, like you said, I'd be lazy about that too. I just don't want to do that. I already have all my players here. Why do I want to go get a whole bunch of new players that I need to schmooze? I'd just rather stick with it.
Right. And I'm always wary when someone calls me, and it happens often enough. Someone will say, "Hey, John, there's this great deal here in Denver or in Minneapolis or Austin." And I say, I'm not that smart a guy. I am sure there are guys every bit as smart as I am in Austin and in Denver, in Minneapolis. How come they're not buying it?
Right.
So I always say thank you and no thank you. I'm not going to do that.
Yeah, I mean, that does make sense. Why aren't if the locals don't want it, isn't that sign of a problem? I mean,
Right.
if they show you a project in Northern California first and you don't like it, they show the four other people that are in the same business as you, and then they show it to someone in Austin, you're like, "Ooh, okay, I guess they're going, they're going for it the opposite way there." And that goes back to what we said before, because it could be something that looks good on paper, but to the local, like it's not working. That traffic pattern's not working. Where as you said, like the anchor's about to go out, they're busting at the seams.
Right.
Yeah. What do you think the most important thing, a piece of like demographic information about an area is for retail? Is it the way of traffic, or is it actually the amount of traffic? Because for self-storage, everyone's counting amount of traffic, but now I'm also thinking the directional is important.
The directional is important, but the traffic count. So we'll look at the total traffic count at an intersection. And let's say 40,000 cars a day would be a great traffic count, and 4,000 cars a day would be a terrible traffic count. But a lot of it is, what are you building? If it's a supermarket, that there's one level of traffic. But what we do is that we rely, kind of to your earlier point, Jonathan, we rely on the tenant's due diligence, on their scoping it out. So if a major tenant, Walmart, says we want to be at this corner, we say, okay, it's good enough for you, it's good enough for us.
Right. Yeah, Walmart doesn't miss very much.
No, and we've worked with them quite a lot over the years. They've been great. But it's what you look at are the income levels, in mile, 2 miles, 3 miles, and the traffic and education, and then the ethnic makeup. We have we have a Mexican market. We had a Russian market for a while, literally selling Russian food.
Yeah.
And so, okay, who's going to buy that? This was in Greater Sacramento, and it's kind of a funny story. Turned out when this Russian market approached us to fill up an empty space we had, we said, "What? Never heard of a Russian market." And then the owner has said, "John, there are 160,000 people from the former Soviet Union, Georgia, Belarus, Russia, Ukraine, living in Greater Sacramento, and they don't have a market." So we said, "Sure." So the
Great idea.
Yeah. Now we're Asian markets are coming on very strong here in Northern California.
Yeah. Before we hop off, tell us about your book, Making It in Real Estate, Thriving as a Developer. What can people get out of that? What's in there? How's it going to help them?
Well, here it is for those of you.
Yeah, there it is. Yeah. It's a nice cover. I like it. I've got it up on my screen here too.
All right. It's kind of a compilation of what I've learned. So I've been doing this for 45 years. Okay, hell, longer than that actually. And it's just kind of each chapter is short. They're about 3 pages long, and each one makes pretty much a single point. It's laced with humor. This is where having a manager or publicist would come in handy, because it's a little bit embarrassing. But since we're dealing directly, it isn't. I spoke at Stanford a couple of days ago. The book is required reading at Stanford, Berkeley, UCLA, Clemson, Vanderbilt, Georgetown, Cornell, and then a whole bunch, dozens of others, but I'm just naming the fancier schools. Yeah. It's called, by the smartest guys I know, they say that this is the best damn book, which is on the cover actually, best damn book on development out there.
Yeah.
You can, if you go to Amazon, you can see the reviews. I'm John McNellis, McNellis. Check it out on LinkedIn. You can become my buddy, whatever it's called, on LinkedIn, and you can see the professor. This talk I gave last week at Stanford, the professor wrote such a glowing review of the talk that I sent it to my wife today. This is today, right?
Yeah.
I sent it to her, and she says, "John, this looks like you wrote it." Because,
that's the best kind.
Yeah, it is. It's a good book. It's out in Audible. I don't. You could listen to it, I guess, in that store in New York City.
Exactly. Yeah.
And you can write me, John at McNellis.com, if you like. And if you do, and if you want to read my monthly essays, all you have to do is send me a note, and we'll link you up with it. But anyway, it is a good book, and it's $20, and I guarantee there's way more than $20 worth of good advice in it.
Yeah. And is the best place for people to go to find you at johnmcnellis.com?
John at McNellis.com.
Yeah, that's your best email, right? Yeah.
Well, I have two. The literary one is johnmcnellis.com, right, and this is John at McNellis.com. I'm very easy to find.
Yeah. Awesome. Well, it's been a pleasure. I really enjoyed it. And I got some tips that I never thought about for retail. So I'm really glad that we did this show. I've done a few shopping center show, but this kind of directional stuff is really making me think about things a little differently. So yeah, I really appreciate your expertise.
Right in, right out, right on.
Yeah. I'm telling you, next book, John, Happiness is an Easy Right Turn. I think it could be something. All right. Thanks so much. Appreciate the time.
My pleasure, Jonathan.
Yep. All right. That was John McNellis. Again, you can find him at his website, johnmcnellis.com, and you can find his book anywhere that you buy books, including Amazon, which we talked about multiple times, Making It in Real Estate, Thriving as a Developer. I'm Jonathan Greene. We'll see you next episode. Thanks for sticking around to the end so you can get a preview of who's coming up on episode 354 of Zen and the Art of Real Estate Investing. And it's her third time on the show as a guest, fourth time on the show overall, which is a record, Alyssa Holbrook. Investor, developer, coach. She does it all, and we go long through her development project and her mindset thinking because she is a very high-level coach. We'll see you next episode with Alyssa.